Let's get across the market open now. Josh Barker joining us from River X. Josh, welcome to the end of the week. What a week it has been. Of course, we have seen that brutal sell-off on equity markets at the moment. What have you interpreted from, obviously, what we've heard from Donald Trump, the prospect of retaliation? Obviously, there's great concern about a global recession.
Yeah, very visceral reaction from the markets last night, to say the least. The worst day since 2020. And 1,000 points on the Nasdaq is definitely significant. So I don't think it can necessarily be ignored. But it was a known risk. It was a known risk that this day had been talked about for a couple of weeks now, and I don't know how anyone wasn't really expecting Trump to come out quite strong in retaliation. I think in terms of our economy, the Australian market, it's a very small impact. He's sort of talking about beef. So I'm not sure why anyone would transport a cattle halfway across the world when there's an hour's drive. US is about 5% of our exports as well. So the impact between the trade war versus Australia is really not that significant. It's more that global growth picture. The other sort of side note, just to almost ignore, would be probably any political reactions that we can have. Main reason is we've got an election coming up in the very short term, and it's very close, so you really don't know what the political reactions and views are going to be in retaliation to those tariffs. But I think it's more on that global outlook. So we had oil off over 7% last night, copper down nearly 5%. I think that's more telling of the overall picture. It's definitely looking a real likelihood of a recession occurring now. Massive slowing in global growth if these tariffs continue. That's the big if. So it's kind of like it's a downward pressure that can be alleviated quite quickly if tariffs were dropped tomorrow, right? So it's not necessarily this large shifting economy that's heading for a recession. It's being forced into it by tariffs. So it'll be interesting to see how long these proposed tariffs stick around anyway.
Is there also likely to be a focus on the second order effects, if you like, on Australia, given what we're seeing in China?
Yeah.
China promising to retaliate, given our dependence on that economy, and also, I guess, those stocks that are exposed.
Yeah, obviously those stocks, our mining stocks, have been under pressure for the better part of a year now. So yes, it does sort of hurt them in the short term, but I don't think it was necessarily an area that was doing quite well to begin with. China has a lot of global growth issues, so it does put more pressure on that for the short term. But it's something that was already pretty beaten down already, so it's not like something that's really sort of hurting a lot of our positions at the moment. We're sort of light in that area, but definitely it's a huge weight on our market, that's for sure. So yeah, that's going to be a bit of an impact moving forward. But I do think that it should be, it's not something that's going to stick around for years to come. The issues in China are probably still something that sticks around for years to come. That's not going to change anytime soon anyway.
And also, obviously, with the increasing prospect of recession, is that central banks are going to have to fight this, and so that leads to the likelihood that we will see more rate cuts than initially. Set.
So Trump's sort of done what he wanted to, with putting pressure on the Fed. Last night we had the US 2-year and the US 10-year go back to pretty much yearly lows, down 15 to 20 basis points just last night, which is almost a rate cut overnight. So it's definitely significant for that market. It's somewhat of a short-term pain for long-term gain. Obviously that boosts equities over the long term. It does help the US with some of their debt issues as well. So you can sort of see the strategic reasons as to why this has been imposed. But I guess, the big question is, how long does it last? He's come out and said that he is open to negotiating. I think his definition of negotiating is different from a lot of people's. So whether that means he'll just outlay his demands and that's it, that's something that the market will be watching quite closely anyway.
So Josh, equity-wise, where do you want to be at the moment?
Look, we've been very light equities, and more so into fixed income, alternatives, property, which has obviously helped out. But I do think I don't think that these tariffs or the share market is going to go down for the entirety of Trump's term, right? And he's obviously gone quite aggressive. It's Trump 2.0. It's the exact same thing he did last time, except last term he was cut short with the coronavirus coming in, so he wasn't really able to reap some of the benefits, but it was starting to happen. He put these tariffs on, puts them in a position of negotiating power, and then they get worked out over the coming months or year. So that was really happening last time, and then it got cut short, and the way he handled that wasn't great. But he's back in now, and he's pretty much just dusted off the same playbook times 10. And with that, I think it will get sorted out eventually. So I think there'll come an opportunity. Maybe not today. Today's one of those ones where you just let it breathe. But yeah, there will become an opportunity where you can allocate into some really good quality stocks. I think those are the names that you're just putting on your watch list at the moment.
Yeah, where would you be looking?
So it's interesting. Like, Australia's got some great tech, and like I said, Australia is somewhat impervious to all of this. Xero is a really good company that has a strong foothold on the Australian business sector. Obviously, if we're going to get cutting rates, that helps consumers, and then obviously a lot of small businesses, whereas what Xero targets. They are reporting next month, so you've got somewhat of a catalyst to try to pick an entry over the next month. It's somewhat relevant. In their last reports, they've been hitting the rule of 40 quite consistently, which is essentially just a measure of these software as a service companies balancing high growth with profitability. So anything above 40 is great. They've hit it for the last 2 reports, I believe. And no reason to think that why they wouldn't hit it in this report again. So that would be really positive for the fundamentals. Stock's down around 20% from its highs. And it's not something that, whilst they are doing some expansion into the US, their goods, their product is not tariffed because it's not a good, it's a service going in there as a software. So it's something that sort of comes under the radar when an Australian good service, I should say, moving into the US. So that expansion still should continue into the US quite well. There's a massive need for it over in the US. They've got a great dominance on the Australian market. That will continue, and then it's just playing out overseas as well.